What if your investments could save the planet, empower communities, and boost your portfolio? In 2025, ESG investing and sustainable finance are transforming wealth creation, with $40 trillion already in play. Ready to discover how to profit with purpose? Don't miss this. What is ESG investing and sustainable finance? ESG investing refers to incorporating environmental, social, and governance factors into investment decisions. It's about looking beyond just financial returns and considering the broader impact companies have on the planet and society. Meanwhile, sustainable finance is the broader umbrella encompassing ESG investing, green bonds, climate finance, and other strategies that direct capital toward projects and companies that promote long-term sustainability. In 2025, ESG factors include climate risks, diversity and inclusion, ethical governance, carbon emissions, and community impact. Investors expect companies to be responsible stewards of resources, transparent about their practices, and proactive in mitigating environmental damage. The global ESG market has exploded, with over $33 trillion in assets aligned with ESG principles worldwide. In the US alone, sustainable investing influences more than $41 trillion in assets, almost half of the nation's institutional funds.
Why ESG investing matters in 2025. Global ESG assets under management have surged past $40 trillion, up from $30 trillion in 2020. This growth is driven by investor demand, especially from millennials and Gen Z, with 80% prioritizing sustainability in surveys. Regulations are pushing it too, with mandatory disclosures reducing greenwashing, those misleading eco-claims. From a risk perspective, strong ESG practices correlate with better financial performance. A 2025 meta-analysis of over 2,000 studies found positive returns in 60% of cases. For example, companies with low carbon footprints avoid regulatory fines and attract talent. In a nutshell, importance of ESG investing is fueled by climate crises, escalating concerns about carbon footprints and energy use, consumer awareness growing around social justice and corporate ethics, regulatory pressures increasing, especially in Europe and some US jurisdictions, financial risk management, as companies with poor ESG scores often face legal, reputational, and financial risks.
Case study: Standard Chartered's net zero banking transition. Let's look at an illustrative case study. Standard Chartered Bank faced the immense challenge of decarbonizing both its operations and the emissions from clients it finances. Their solution? Release of a comprehensive net zero transition plan in 2025. A commitment to net zero operational emissions by 2025 and financed emissions neutrality by 2050. Setting interim targets, including a 29% reduction in oil and gas-related emissions by 2030. Scaling sustainable finance products, green bonds, and loans to fund low-carbon projects. Integrating climate risk assessments into credit decisions to minimize exposure to unsustainable clients. Impact. The bank generated nearly $1 billion in sustainable finance income in 2024, expected to grow in 2025. It strengthened investor confidence by maintaining leadership and transparency in climate action. The plan demonstrated that profitability and decarbonization can align when sustainability is integrated into core business strategy. Key takeaways: science-based, externally verified targets build credibility. Acting on ESG attracts capital and drives innovation. Long-term sustainability and financial success are interconnected. Challenges in ESG investing. Despite growth, ESG investing faces challenges. Greenwashing. Companies exaggerating sustainability claims can mislead investors. Standardization, lack of harmonized ESG metrics hinders comparability. Political pushback. In the U.S., some regulators and political groups challenge ESG-focused regulations, causing uncertainty. Data quality. Inconsistent, incomplete, or biased ESG data can distort assessments. Balancing returns. Investors struggle balancing short-term returns with long-term sustainable impacts. Efforts are underway to address these issues through improved regulations, AI-driven ESG analytics, and greater transparency. Opportunities and the future of ESG. The future of ESG investing in sustainable finance includes expansion into new asset classes like green bonds, social impact bonds, and private equity with ESG focus, utilization of AI and big data analytics to improve measurement of sustainability outcomes and risk management, growing impact investing that targets measurable social and environmental returns alongside profit, increased investor demand for solutions aligned with UN Sustainable Development Goals, or SDGs, particularly climate action and clean energy, global collaboration to harmonize ESG standards and reduce fragmentation. Investment in sustainable projects is proving both ethical and financially viable, with growing evidence of competitive returns.
In conclusion, ESG investing and sustainable finance are transforming global finance in unprecedented ways. The Standard Chartered case shows that serious climate commitments pay off financially and can shape entire industries. For investors and viewers interested in protecting the planet while pursuing returns, understanding ESG is essential. Keep an eye on verified ESG data, growing regulation, and innovative sustainable finance products. If this helped enhance your understanding of ESG investing, please like and subscribe